As you know, if you zoom out, put it on a log chart, it is right. It does trend perfectly. It's just that the cycles within that trend, when you don't put them on a log chart, look horrific, and most people don't have the stomach for it. You and I have been around this long enough to realize the pain is part of the risk is part of the reward. You have to go through that to have an asset that goes up 20x, each cycle. So I think it's been decoupled for a while, as you say. It feels that new capital's coming into the space because it's moving out of the risk curve. So we saw Bitcoin going up first part of what I call crypto spring.
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discuss about Bitcoin. Raoul Pal says it does trend flawlessly. Simply put, most people lack the stomach for it, since the cycles inside that trend appear horrifying when they're not displayed on a log chart. I've been around this long enough, along with you, to realize that the agony is a part of you must endure that risk in order to reap the benefits of having an item that appreciates in value 20x, every cycle. So I believe there has been a long period of decoupling, as you say that, because the industry is perceived as emerging from the risk curve and seeing new capital enter, Bitcoin rising early in the season. I refer to as crypto spring. Thus, Bitcoin dominated the market the entire year and was fueled, I believe, by only SZ bleeding and that washing machine. But we're beginning to notice a shift in favor of the ETF, and that obtains front-running of funding from hedge funds and other sources. And finally, we learned about the news. I'm not sure how much that BlackRock has started to purchase today, but let's say a couple of $100 million in any case. Therefore, this is how to approach the ETF. And lots of things Raoul Pal discussed, so please watch the video to end. And share, subscribe our channel Everyday Finance, thanks.
Yeah. As you know, if you zoom out, put it on a log chart, it is right. It does trend perfectly. It's just that the cycles within that trend, when you don't put them on a log chart, look horrific, and most people don't have the stomach for it. You and I have been around this long enough to realize the pain is part of the risk is part of the reward. You have to go through that to have an asset that goes up 20x, each cycle. So I think it's been decoupled for a while, as you say. It feels that new capital's coming into the space because it's moving out of the risk curve. So we saw Bitcoin going up first part of what I call crypto spring. So all year it was Bitcoin, and that was driven by, I think, just alts bleeding and that washing machine. But what we're starting to see is movement towards the ETF, and that gets front running of capital from other people as well, hedge funds and others. And then eventually we got the news today that BlackRock has probably started to buy some. Who knows how much that is, but let's call it a couple $100 million. Either way. But so the way to think about the ETF, I think, is really useful. Here's the crypto economy, and it has been starved of new capital recently. And the ETF is a trade deal between TradFi, the TradFi economy, and this new economy. So we've just started a trade deal. Doesn't mean we're going to get the trade, but it's looking like we'll start to get foreign direct investment into the crypto economy. What happens then is how I think about this. My mental model is, okay, so the money goes into Bitcoin first, but everybody who's been in this market has been front running it by owning Bitcoin. So then the next thing they'll go is, well, they're going to do the ETH ETF next.
Of course, an index, an index of the top 50 altcoins, right? Yeah.
It'll go to the ETH ETF, that will run. And then meanwhile, we've got other stories of things that are getting traction, Solana, Chainlink, others that are starting to rise as the capital's coming into the space and people are placing risk bets in things that they think might work in the cycle.
According to Raoul Pal, there's only a portion of the trade deals that will flow from the traffic to the cryptocurrency economy. This is just one of them. The ETH spot ETF will also occur, though it will obviously happen later. Everyone will front run it by going to the ETH one as soon as the Bitcoin are finished, because they know that's the next one we will see. We will also see the rise of the hedge fund industry, as well as the capital and pension funds coming in. Teachers like Matt Halstead and Mike from Texas are kind of leading the way in this regard, so they're all coming. I disagree that it was a one-time occurrence. Yes, Some see it as bringing liquidity to the cryptocurrency market, but I see it more as a trade deal. Trade agreements truly begin to bear fruit when investors begin to see a return on their investment in the new market.
So look, that's just part of the trade agreements going to come from TradFi to crypto economy. Just as this is one of them. The ETH spot ETF will happen as well.
Of course.
It'll be later, and everyone's going to, as soon as the Bitcoin one are done, they'll front run it by going to the ETH one because they know that's the next one. We will see that. We will see, the rise of the hedge fund industry, the capital coming in, the pension funds coming in. Matt Halstead and Mike from Texas Teachers are kind of showing the way and how that's done. So they're all coming, and it will all happen over time. The Bitcoin ETF, I don't think of it as a one-off event.
I agree.
People are thinking of it as like this liquidity injection into the crypto economy, and I'm saying it's a trade agreement. Trade agreements really start working when people are starting to get return on their capital in that new economy, and then they pile in. Do you remember when China started opening up and people started putting a little bit of money there? Before you knew it, you'd be in Shanghai and everybody's been posted there, being given like $1 billion. Set up an office for us there. Figure out how to make money. That's what will come. So I'm less concerned about the start, but this pipe is going to be an important pipe to bring kind of RIAs and others into the space as it moves. But I know all of these people. I know them personally. They all know it's everything.
Okay, good.
But firstly, and the people who are building it there are not some evil finance people. They really care about it.
Yeah.
And they really care about this space. They're in it because they truly believe in it. Abigail Johnson at Fidelity truly believes in it. I can't remember the lady who runs Franklin Templeton.
Well, Sandy, she doesn't run it, but Sandy Call there. Yeah, she's incredible.
Not Sandy. Who's the woman who owns the whole thing?
Now my brain's not working, but yes, her boss.
But yes, another amazing genius. These people truly believe in it. So what they've got the issue with is regulation is slowing them down. And size of the market is still too small. It needs to be of a certain size before many of these large pools of capital can use it. It's like I've got an asset management business called Exponential Asset Management, and it's a fund of hedge funds. It invests in lots of different hedge funds. So the hedge fund space in the traditional markets, $4 trillion. That's why traditional markets are really deep. They've got lots of liquidity. You can get shit done. The entire size of the hedge fund industry in crypto is $6 billion.
I didn't know the number, but that's, yeah.
And which is why retail are all of the liquidity. And, in the end, we need these institutions. That'll get rid of some of the volatility. Yes, it'll lower the returns, but we'll get the return cycle. But we can't have such illiquid markets driven by some random trading firm out of Hong Kong or, that we don't trust. It's like this has to stop. We need proper capital in the space. Putting that capital in the space will have a multiplier effect. So everyone's going to get rich as that capital comes in, but we need it. But I think of this like an option, right? So the more the treasury yield goes up, the more we're all going, oh my God, a car crash is happening. The more the banks go down, the more the option that the Fed have to do something comes back into play. Yield curve control, right? So this is like an option play. Yes, we've got the ETF story going on as well, but it's also, gold did the same thing. It started to suddenly shift from being fearful of rates to bring the rates up because we know what you have to do. You have to do yield curve control, or you're going to have to do something to stop this, because if not, you're going to blow up the banking system.
So we're still living in the upside down where bad news is good news and good news is bad news. It's pretty absurd, to be honest, to be living through this time. But what's interesting is that people keep cheering for the rates to rise, as you said, yields to rise, because they think that something will break, the Fed will pivot, liquidity will come into the system, and we'll have yet again a fiesta of raging markets. But when the Fed pivots, usually prices go down. That's when you actually see the stock market correct massively. And we're about to see the yield curve potentially normalize here and uninvert.
Yes, but normally the yield curve going back to positive sloping usually has happened because they're cutting rates at the front end. But this is completely different. This is this excess spending idea and who the hell's going to buy all the bonds. And meanwhile, Janet keeps issuing them because rates keep going up, so they issue more. And everyone's like, well, this is a total fucking shit show. And, you know, the Japanese did yield curve control within that. So I don't believe that signal is there. I think, you know, that the more the curve goes closer to zero, because the long end's going up in terms of yield, the more it's a sign that they're going to have to do something. You know, my point I've been making for a long time, I think last time we spoke, I said this, is the recession got priced in last year. Crypto assets don't go down 80%. The NASDAQ went down 35%. You know, the long end of growth technology like ARK was down 78%. That was the recession, right? So what we've got is markets that are forward looking because they understand the liquidity cycles now. So that's why they're going up and have been going up. You know, I managed to participate in most of this in both crypto and in technology stocks because I knew that liquidity was coming back slowly. So even though the Fed are doing quantitative tightening and the Treasury issuing, because of this drawdown in this reverse repo, all of this stuff basically means they've not been tightening liquidity for ages now.
No,